Hi, hello. Can you guys hear me? Is anyone can hear me?
Yes, we can.
Okay, okay, good. Okay, so let's start with the disclaimer. Once you go through the disclaimer, I gave you some exercise last week. Who was able to do some of the stuff? Like, did anyone find it out which one was the very good rate of return on investment produced by any company out of the list of those 10 companies? Okay, so you should still remember the way how to calculate the rate of return, because the purpose of that exercise is to get you aware and to get you familiar with how to find it out the future value of the company. So if you have not done that, you can do it later on after finishing this lesson. But I will suggest you and recommended you do that stuff, because that exercise is very important exercise. All exercise, what I'm going to put it here, it's going to teach you, it's going to make you learn you how to do the calculation. And if you are not, if you don't do exercise, then you will forget about it. How did I do that? And every time you have to go through the video or something like that in order to find that. So in this lesson, I again say, please do exercise, whatever exercise I give it to you. That exercise will help you in the calculation later on. So in today's lesson, what we're going to go through important investment terms. Now these terms are important because when you want to value the company, you should at least know this stuff, these terms. If you know these terms, you can find the value of any company. And learning this term is not that hard. It is very straightforward and simple. And if you talk with someone about investment and he tells you enterprise value, you should not be surprised what is enterprise value, because these are very basic terms you want to learn. And it's not that hard. I mean, so we go for the first one, which is called the market cap. So if someone says Apple has a market cap of 2.3 trillion, what does actually mean? What does that mean is, if you have a total value of all company share of stock, and it's calculated by multiplying the price of a stock by its total number of outstanding shares. So for example, a company with 100 shares will get $50 per share. The company's market cap is $5,000. So this is the easiest way to find the market cap. The market cap means whatever total outstanding shares are there, multiplied by the current market price, and that should give you the market cap for the company. So in this example, if you see Apple market cap, if you want to calculate Apple market cap, we can do that. And I will show you how to. You don't require to calculate market cap, because It's going to be there. I just want to get familiar with the terms and how the market value can obtain. But it is always going to be there, and it changed by second because the market price of Apple changed by second. But if you want to calculate the market cap, we can go to the Yahoo Finance. Okay, here it says 2.313 trillion. So you can always get market cap like that, but you can also find market cap by going into statistic, find it out outstanding shares. So Apple has a 16.19 billion outstanding share. That 16.19 billion outstanding share, if you multiply by today's close price, which is $142.92, will give you total market cap or market cap for the Apple. And that also reflect here. They will just calculate for you. But if somebody asks, or if somebody is talking with you about investment and use the word market cap, this is what the market cap means. The second important thing after market cap is the enterprise value. Now, this is the most important thing or value, because the business transaction, when somebody buy out the whole business, they will buy out based on enterprise value, not on the market cap. Because enterprise value is consist of market cap, and then you add whatever the cash company has, and then you reduce the debt, whatever the company has. So in order to find Apple's enterprise value, we have to put the market cap, which is 2.249 trillion. And if you see Apple statistic, if you go to the statistic, if you go all the way here, you will see there is a total cash balance for the Apple for the most recent quarter. So this is 51.51 billion. So we are adding 51.51 billion. And then you have to find it out, the Apple debt. It's debt around 120 billion. So we're going to minus 119.98 billion. So today or tomorrow, any company wants to buy out the whole Apple without paying any premium, of course. They have minimum have to pay 2.36 trillion, because that was the market cap. They add the cash on it, and then they reduce by that. So the enterprise value is many times used when there is a new company, and we will look into that in the future lessons. But many times, many of analysts or many of cash flow analysts use enterprise value to EBITDA rather than using price to earning ratio. And that's why I want you to get familiar with enterprise value. So even in Apple, if you see, they look on this figure here, enterprise value to EBITDA. Now, if the company is brand new, not making any money, then we don't have any EBITDA because company is not making any money. And if I want to purchase the share and I want to figure it out if I'm paying more or less, am I paying higher than what the value should be? I always go for enterprise value to revenue ratio, because when you don't make any money, you have to find it out how many times of revenue you are paying. So for example, if you see Rivian, which is the electric car company, they are not making any money right now. So you will see the EBITDA negative. Enterprise value to revenue is too high. Usually I don't want to go over 10. This one is trading around 55. But we will look into that when we when we learn about how to value the company and calculation. In investment, the most important thing you want to learn, and I will say anybody can learn. The first important thing, you don't need a higher IQ. You just need a common sense. You act like a business owner. If you use your common sense, many times, 90% times, your decision will be right and you will make a lot of money. Second thing in investment is the temperament, which you have to develop. And I have an exercise for that, how to develop when the market crash and your portfolio is down by 50%, 70%. You don't want to get panic. And that brings us to the valuing the company. So if you are very sure about that Apple, if I have all the money in the world, and if someone tell me that I can buy the Apple at current price, should I buy it? If I said yes, then if the price drop down 50%, I will not be mad, because I know the Apple value is $140. It is like a house. You know your approximate house value, not pinpoint house value. You know approximate your house worth $500,000. Every second someone comes to you, your neighbor comes to you and say, I will pay you $490,000, sell me your house. I will pay you $480,000, sell me your house. I will pay you $520,000, sell me your house. In all these instances, the price fluctuates what your approximate house value. But if one day your neighbor is very depressed and it comes and he said, would you buy my house for 200,000? And you know that this same house is probably worth of 500,000, your neighbor house. And you said he's making mistake. He's giving you for 200,000. Then you will take advantage of it. And that is all the market about. You need to know not exact price, but you need to know the value of per share. How people have the different perspective, people have a different way to calculate value of the company. Whatever way you calculate, whatever your decision, if one day you buy 100 shares of Microsoft, you should be able to tell yourself, or you should be able to explain other people in 2 minutes or 3 minutes, why did you purchase Microsoft? See, if you buy because somebody else has told you, it's not good enough. You have to do your own homework. And your value may be different. Maybe I am thinking that Microsoft at $250 is not a good buy. Maybe I'm thinking I would probably buy it at $200, which is fine. And your friend is purchasing at $250 per share. It's also fine if he's calculating the value. But if someone tells you just buy Microsoft because it's a very good price, it's not enough. Because what's going to happen, you don't know the value. So tomorrow or in the future, if the value drastically dropped down, like current market, 50, 60% down, you would get panic, you will sell your stock, you will take loss. But if you know that, oh, definitely $200 Microsoft is awesome buy at $200. And if it's available at $100, I will save money and I keep buying the share rather than selling at $100 and take $100 loss. So in investment, most important thing is valuing the company. And then we can step by step go over. But once you know the value, it is very, very difficult for you to sell something for the loss because you don't get panic when price crashes. In the neighbor example, what we saw, that the neighbor probably have seen that few of houses in the same street were sold for 250,000 and he got panic. You know the value of the house is 500,000. He got panic, he want to sell for 200,000, he want to purchase it because you know the value. It's approximate 500,000, I'm making 300,000 right there. So the enterprise value is very important, and we will see more example of enterprise value, how to calculate. You probably have many times hear about the book value. What is the book value? Or many times people or financial experts use the word equity, shareholder equity. The shareholder equity and book value is same. Some people call book value, some people call shareholder equity. Basically, shareholder equity is if you have a company with $1,000 asset and $900 debt, your shareholder equity that invested in that business is $100. Your book value is going to be $100. Now, if there are 100 outstanding shares, then you divide the book value by outstanding share. So your book value is $1 per share. Again, just make sure you know this book value concept, because book value also in future lessons I will show you how the book value affect the price to earning ratio. But for now, we just focus on what is book value. It's simple. You take all assets, subtract all liabilities you have, whatever is left, it's a book value. Divided by outstanding shares, you get a book value per share. Now, after book value, the most important thing is intrinsic value. So when I say intrinsic value, so sometimes the book value, if you see Apple, for example, we go to Apple example again, okay? Do you see the book value of Apple? I mean, you guys can, if I ask the answer, you can unmute and you can talk with me. Is anyone saying what is the book value of Apple? It's right over here, book value per share. How much is it? Anyone?
4.16.
That's right. It's 4.60, right? So what is the book value? Is all asset Apple have minus all liability Apple have divided by outstanding share, which are 16.19 billion. Okay. If book value is $4.16, why you are paying for Apple $142? Does anyone have any answer about this? The book value is $4.16 per share. Okay. What you are paying right now for Apple, $143 per share. You are paying $139 more than its book value. Because those $139 is it's because Apple's brand name. It's because the people's retained with the Apple. It's because you are paying that much high premium because of the stability of the business, earning power of the business. Many times when you heard Warren Buffett or any other big investor, they always talk about intrinsic value. Intrinsic value is a little bit complicated to understand, and you don't require to go in a very depth calculation, because there is a very depth calculation available based on the free cash flow. You can find the intrinsic value of the company. But if I put in a simple way where you can understand what is the intrinsic value. So take example of Tom Brady, the NFL player, right? The most successful NFL player. So when the initial draft was happening, I think they have to select 200 people. Now, out of 200 people, Tom Brady's rank was 199. At that time, let's say you are coach, and you looked at Tom Brady, and you say he's not worth to be at 199. He's worth more than that. So you go to the Tom Brady and you say, you know what I can do? I can pay you right now, because what I'm seeing, your potential, which is intrinsic value. I'm going to pay you right now $300,000 salary per year. For that exchange, when you started to earn money, you pay me 15% of your earned money, and we will make a contract, and I will keep paying you $300,000. If your performance improve, I will pay you a little bit more, but all future earning you going to earn, you have to give me 15% of it, because you figure it out Tom Brady's intrinsic value at that point. So Tom Brady, what he did with $300,000? With the $300,000, first thing he did is hire the good NFL coach. He hired the nutritionist. He hired the workout person. He started to work very, very hard. These are called book value. See, you are investing money. Let's say he's spending $70,000 or $300,000 to pay, to improve his game, to dietitian, to workout guy, to gym membership, anything that improve his performance. That $70,000 is book value. So book value is what you put into the business. That is called book value. Like when we talk about the book value previously, I said all asset minus all liability. right? And that is the book value. So $1,000 were asset, $900 were debt, $100 were your money, and that is the book value. But the intrinsic value cannot be same as a book value. Intrinsic value is way ahead. If the company has so much potential, like Tom Brady, its intrinsic value is going to go very high. And to understand the intrinsic value, I just give you this one example. But basically, in the simple definition, the intrinsic value is calculated. It's estimate all companies' future cash flow. Calculate the present value of each of these future cash flows. Sum up the present value to obtain the intrinsic value of the stock. So that's why I said that in the previous lesson, I gave you one exercise to find it out the present value, to find it out the rate of return. There were this, when you want to find intrinsic value, that exercise would have helped you. So please do exercise, because that is most important thing. Otherwise, you will hear and then you will forget. So if we want to get, how many of you understand the intrinsic value well? We have another example where I can show you. You don't have to worry about intrinsic value that much. Not Warren Buffett, not anyone in the world can pinpointly calculate intrinsic value of the business, because you are talking about the future cash flow. If I have a business, I don't know, and many of you don't know, if you have a business, what would be my revenue next month? We are talking about future cash flow until the judgment day of the company. It is impossible. But you can do it. And there are calculation available, Excel sheet available, but everything is estimate. There is no pinpoint, there is no scientific thing. It's everything required to be estimate. Even if you discounted it, again, this terminology of discounted to the present value, I have shown you in the first lesson, that why we discount it to the present value, future value, and what would be the interest rate. At that time, this concept would make it more clear, clearer if you have gone through that exercise. So right now, just think about intrinsic value is not the book value. It's not the real all asset minus all liability equation. Intrinsic value can be far, far than the book value of the company. And you see that example with Apple. Apple has only book value of $4. So the intrinsic value is, and if you want to understand more, how many of you want to still understand more about intrinsic value? Then I have one more calculation, and we can go over it. Okay, so I will assume that you have a little idea about intrinsic value, and that is enough, because you don't want to go into detail. There is no way you can calculate pinpointly intrinsic value of any company, even Apple, because the future earnings variations, there are so many variables, there are so many outside variables that fluctuate that revenue, that fluctuate. Sometimes war happen, and you have calculated growth of 10% year to year, and now Apple, instead of having growth, is turning into the negative percentage, and whole your calculation about intrinsic value will be far from what you have decided or what you have created. So right now the intrinsic value, just think about this way. Tom Brady example, the intrinsic value is far. When he was get selected, he was 199th number. So he would have, if he would have missed that, nobody have taken him into the NFL. And his intrinsic value is so much, was so much at that time that people didn't understand. The coach didn't understand. His potential was so much. So it's the same thing with the intrinsic value. What you see, it's not always like that. So let me see. So here I have one more intrinsic value calculation, and which is very self-explanatory. I have taken it from my book. You can go through this. If someone wants to understand, I will definitely, you can contact me. But it is very in just that much. I think the intrinsic value, what we have right now, I taught you, just remember that much. You don't need to learn more. I mean, you need to understand more about that. So now we coming where many analysts use EBITDA. It's called earning before interest, taxes, depreciation, and amortization. Now, out of this EBITDA, what happened with EBITDA will not give you complete financial picture of the company. The reason, there are two terms that has been included in that. That has not been included, which is depreciation and amortization. So what this says, that earnings before you paid any interest, means whatever you have borrowed from the bank, you pay the interest on that. So you are saying EBITDA means earning before interest. So you are not including interest. Before tax, you are not including tax. Before depreciation, you are not including depreciation. And before amortization. So EBITDA will not give you the right picture, and I will show you why. But you have to remember and know this term, because many times analysts or financial people will use these terms to value the company. They will say, I can pay 23 times EBITDA to revenue, or I can pay 5 times EBITDA. At that point, you should not be surprised of what is the EBITDA. EBITDA is means simple thing is earning before interest, taxes, depreciation, and amortization. Now, earning before interest and taxes, Warren Buffett said that is fine. That is valid when you want to calculate the income. But by excluding depreciation and amortization, it is not giving you the correct picture. So we will look onto that. What is interest and taxes are self-explainable. We go to the depreciation. So the depreciation, what happened, that the simple term, a reduction in the value of an asset with the passage of time due to wear and tear. An example of depreciation, if an equipment is purchased by a company that cost $100,000 and the expected usage of the equipment is 10 years, the business might depreciate the asset under depreciation expense as a $10,000 every year for a period of 10 years. The reason why you have to use the depreciation, because what happened that you have bought the equipment which cost you 100,000, and sometimes you cannot take that as a straight line expense. The reason why you cannot take the straight line expense on that, the straight line expense means you cannot put the whole $100,000 expense in a given year, because that assets, it's not going, that assets life is 10 years and you are taking all expenses at once, and that makes you pay less tax, and government doesn't like that. So the government says that if your equipment is cost you $100,000 and you have to replace the equipment after 10 years, means you're going to use your equipment for 10 years. So that means you can only take $10,000 per year depreciation expense. You cannot put $100,000 expense right away. So when we look in EBITDA, we are excluding depreciation, which is not right, because what's going to happen that after 10 years, you have to spend another $100,000 to replace your equipment. And we are excluding that here. We are not counting that thing here. So the EBITDA, the earning is inflated, because what happened that we are not including the depreciation. So the depreciation is a real expense and you cannot ignore it. But the financial term has created some loopholes by doing EBITDA, so that what happened that they can favor the transaction higher than the EBITDA, or they can justify the transaction. But don't go into that much detail. We see the depreciation means this is it, like after 10 years you have to replace the equipment. So depreciation is real expense. So by not including this in EBITDA, it gives you false financial picture of the company. The thing is amortization. Now amortization is very interesting part, because amortization actually is not real expense. It is so what happened that when you have to do amortization, so let's say you are buying any business, the business book value, like Apple. Okay, so we are buying one share of Apple. Okay, think of Apple. When you see the Apple, what and amortization is it required for balance sheet, to balance the balance sheet, and that's why amortization is not real expense, and I will explain you why. So usually the amortization, how you calculate is, we are buying one share of Apple, which is $143. Okay. Now, how much premium are you paying? Whatever you pay above its book value, it's a premium. So Apple's book value is $4.16. So the premium, how much premium you are paying is $139. So 143 minus $4.16. Now here is the problem happens. The book value is $4.16 and you are paying premium $138. And to adjust the balance sheet, it gets tough. So financial metrics, they figure it out. What you can do is this excess value, what you are paying above book value, which is $139, you can divide into 40 years. And every year, so that is $3.47. Every year pass, you going to amortize and balance your balance sheet $3.47 every year until you exhausted $138.84 after 40 years. And you don't need to learn about this because you're not going to be these terms. You just have to understand what is amortization, because amortization is not real expense. And anytime you buy any company, like Warren Buffett buy any company over book value, the premium, what he paid over book value of the company has to be amortized 40 years from now. So what happened when you amortize this $3.47, what you are doing is you are reducing from your earning. But this is not real expense. $3.47, you already have paid that. You already have paid the premium to the book value. This is not real expense like depreciation, where depreciation, in case of depreciation, you have to replace the equipment after 10 years. Amortization is not the real expense. So what happened when you go through the traditional accounting, which is they generally called EBITDA, or if you see generally accepted accounting principle, or known as a GAAP, there are so many chances that you can manipulate the earning figure. So what happened that you can make fool investor by using depreciation and amortization in a bad way. And so what Warren Buffett says that if you want to really find it out, and these things you cannot even manipulate. You have to go for owner earnings, that is the Warren Buffett term, owner earnings or free cash flow. And the free cash flow or owner's earning is the backbone of the company. If you EBITDA, you can manipulate. GAAP, generally accounted accepted principle, you can manipulate. Free cash flow, you can't manipulate free cash flow. So if we go to, I still have a 5-10 minutes. Okay, so let me go to this owner's earning. Okay, so we go to, anytime you want to find owner's earning, before you find owner earning, you need to know that every quarter company release their quarterly earning. And in the quarterly earning, there are 3 important things. One is called income statement. So one is called income statement, which is here, balance sheet, and cash flow. All companies have only these 3 segments. The cash flow is the most important part. So if you want to find it out, Apple's owner earning, okay, let's find it out, Apple's owner earning for this quarter. So analysis said June quarter, let's see here. Okay, so here is a March quarter. Okay, the March quarter earning per share estimated was $1.43. Actual come $1.52. Now this $1.52 is based on GAAP. Again, the GAAP you can manipulate. So instead of, we will go for free cash flow. So to find free cash flow, just make a note of this $1.52 value that is created by the generally accounting accepted principle. We just need to find it out one more thing, which is the outstanding share, which are 16.19 billion. Okay, so, and also this will show you where to find these values. So you go to Apple's website. You can always go to Apple's website. Again, if you go to the profile, then click on apple.com. It will take you to the Apple's website. Once you are on Apple's website, try to find it out where it says investor. Okay, so about Apple here, it says investors. That place you have to go. So go to the investor. Now, third quarter result, July 28th. So that is already done. It is already going to come. So this is it. This is the latest quarter financial statement, which is the quarter 2. Now remember, you have noted down $1.52 per share. Okay. So we go to the financial statement. In financial statement, they will show you 3 month and 6 month. Their diluted share and basic share. I don't go for all this stuff. And here you can see it says $1.52 with the conventional accounting method. Okay, this is the balance sheet going on. I don't even look more on balance sheet side. The only thing I have to give importance is the statement of cash flow. Okay, in the statement of cash flow, you have to find this number. So you always want to go to cash generated by operating activities. So the cash generated by operating activities for the March 2022 quarter was 75,132 million. Okay. Okay, so if you look here, this is the net income. See here, the depreciation and amortization is added. So what this does, that remember that EBITDA is excluding depreciation and amortization. Here, depreciation and amortization is added back into the statement. The problem with this is, if you are adding depreciation, you again making the cash flow statement incorrect, because depreciation is a real expense. So what Warren Buffett says, that what you can do is see this cash generated by operating activities, 75,132. From investing activity, there is a column, or there is a row, sorry, it's called payments for acquisition of property, plant, and equipment. So this is the real expense for that particular quarter. So that expense was 5,370. So you deduct that expense, 5317 from 75,000. So that will give you free cash flow. And this is common for all stock. You go to any stock's website, go to any quarterly earning, find out the cash flow, minus capital expenditure in form of property, plant, equipment will give you free cash flow. The free cash flow is what we want to know. Free cash flow means the company has a free ability to use those cash. Either they can give you dividend from there, either they can buy back all shares, they can do some other acquisition, they can buy back another company. But the free cash flow is the most important thing in any business. Warren Buffett looks for free cash flow. And so if we want to find it out, 75,132 minus 531. So then 69,800 dollars is a free cash flow. But we want to find it out on a per share, because we are talking about per share. We want to find it out per share how much. The $1.52, the general accounting accepted principal value, $1.52 you saw previously here, that is per share figure. Okay, so we have noted there are 16.19 billion shares outstanding. So this is 69 billion. Let me make sure. Yeah, 69,815. So this is 69 billion, 69.81 billion. So 69.81 billion divided by 16.19 billion, which is outstanding share. See, the free cash flow came $4.31. This is the real money, $4.31. The conventional accounting show you what? $1.52. And you're going to pay the price based on this, $1.52. But if you go for free cash flow is high. Apple actually is making $4.31, not $1.52. So the free cash flow, the only disadvantage with free cash flow is only one thing, that it fluctuates more in given year. The reason why it fluctuates more, because let's say in this current quarter, they have spent about 5,317 million for purchasing property, plant, and equipment. But in some quarter, this value will be 15,000 or 20,000. And that time, if the cash flow is still same, that time your free cash flow get reduced, because purchase of property in that particular quarter, they have to invest heavily to purchase the property, plant, and equipment. So free cash flow on base of year, you can also find it out based on year. And for that, instead of going to the quarterly statement, what you can do, go to annual report. So if you go to the annual report, this is the annual report of Apple. Same thing, you have the statement of operation, income statement. And this is the balance sheet. And we go to here. So this is the cash flow, okay? Go to here, this figure. This is yearly figure, not quarterly figure. So the cash generated by operating activities is 104,038 million. The year before they have made 80,674 million. Year before that they have made 69,391 million. You can see the jump in the revenue. It's huge. And so many times I tell market is not efficient. You know why? Because see the Apple price for last 3 years. It's right over there from, if I want to find it out, 3 year. The 3 year, did you see the jump in the revenue? How much jump in the revenue was there? So the first year, 8674 divided by 69,391. So they made 16% more revenue. Then in the next year, they made 28% more, 28% more revenue they have generated. What happened to the stock price? Stock price should increase by 28%, right? Let's see what happened in last 3 years. Let's see. So in last 3 years, no, I think that their prices increased quite a bit. Yeah, I was wrong about that because it reflects that. Yeah. So you see that $177. Hold on, because it's 2021. That's not. Okay. Yeah, so the market has reflected, but many times market doesn't reflect. I mean, 30% revenue increase and stock price remains steady, same place. But in the case of Apple, it did reflect it. But again, here we will come back to our main thing. If you want to find it out, free cash flow for 2021, you take the number 104,038, then deduct your capital expenditure, which is here, payment for acquisition of property, plant, and equipment. So Apple in last year made $92 billion free cash flow. If you divided that with outstanding share of 16.19 billion, sorry, 92 point. The free cash flow comes $5.74. Last year, Apple made, after deducting all expenses, everything, paying everybody, everything, they still had $5.74 cash to spend. And if you see the last year, Apple's earning for 2021 in financial, that number would be different. So the last year, they made how much? Okay, so they're saying they're in general accounted accepted principles saying $5.61. We have figured it out $5.74. The conventional accounting and the free cash flow is like very close. But in that another example where we see the conventional accounting was $101.52, where the free cash flow was a $4. So what I want you to do, this is the exercise 2, and please do this one. Find book value per share, EBITDA, enterprise value. And now you can add one more thing here. Find the free cash flow, because I show you how to find free cash flow and how to go to the website, you have to go to the company's website. So I will show you another example is Google, let's say. Okay. You go into the Google profile in Yahoo Finance, go to the profile, go to the Google, and here it would say somewhere investors. Go to investors. If you want to find it out whole year free cash flow, go for 10K. PDF or HTML, anything, let's say HTML. In there, you just have to find it out, the cash flow statement. This is hard. In the PDF, what happened, we can just go here. Financial statement in supplement data. Go to statement of cash flow. Here we go. So the same thing, net cash provided by operating activities is 54,520 million. How much did they spend for the purchase of plant and equipment? You have to find it out here. It says purchase of property equipment. Only this row you have to select from investing activity, not other rows. Purchase of property and equipment cost them $23,548. 548 million. So deduct 54520 minus 23,548. This is the free cash flow Google made for year 2000. Oh, we are looking at wrong year, 2019. We go to the 2021. Let's see. 91,652 minus 24,640. 67,000, and we have to divide this with the outstanding share. So we have to find it out, outstanding share. We can find it out from statistic. How many outstanding share Google have? 313 million. So 314 count as a 314 million. So it made about $213 free cash flow per share. So I want you to go through these exercises. So in the last slide, I want to add you one more thing, finding out free cash flow. And then we will meet again next week, sometimes. Let me see. So if you have any question, just let me know. If you have any question, if you don't understand any part, we can go over that within 5-10 minutes. So anyone have any question? Did everyone figure it out how to find the free cash flow? This is the recording, so you can always watch it again and again. But I just want to see that if you guys understand basic concept. This thing looks a little bit complex right now. It is not that complex. But you have to get aware, you have to have the knowledge about these terms, because without that, you won't be able to estimate the value of the company. Anyone have any question before I stop this meeting? Okay, so please do this exercise who has attended today's video. Please try to do for all these companies. That would be very good practice for you for the future when we try to evaluate the companies, when we try to find it out the price of the company, value of the company. So with that said, we will meet again next Wednesday from 5 to 6, and I will post the Zoom meeting link into the both group. Okay, bye.
Goodbye. Thank you.
Bye.